Today is Monday, October 1st, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, Vice President of Grain Research at ADMIS, and Alan Bush, ADM Investor Services Senior Financial Economist. Steve, let's start with the grains this morning. First off, what did the USDA say about the U.S. September grain stocks, and how did the market react?
In all three grain commodities, corn, soybeans, and wheat, they found stocks bigger than expected. So the market reacted negatively, especially in the corn when the funds came in and sold 20,000 contracts.
Soybeans, meal, and corn, though, are higher today. Why is that?
NAFTA. Everything is up because of NAFTA. They had a deal over the weekend, and so a lot of people feel that in the grains, if supplies stay high, that this is a good sale for the grains. The only other thing is that we might be wet for the month of October across the Midwest. That might be helping us a little bit today too. But in general, if this rally in the grains today is all because of NAFTA, it should be sold.
Yeah, so the wet forecast over the next 30 days, can you talk a little bit further about that? How does that affect harvest?
Well, first of all, it's going to slow harvest down. The wettest weather will be from eastern Kansas up through Iowa, northern Illinois, and southern Wisconsin. So in areas outside of that region, they should be able to get harvest done. And as of last week, we're a little bit ahead of harvest. It shouldn't affect yields, but we'll just be watching the basis. We'll be watching some of the spread action. And I don't think it's going to help futures, but I think in general, we'll get it eventually harvested. We always do.
Talked about trade, NAFTA. What impact will the new NAFTA deal have on grain prices overall, and conversely, the lack of the U.S.-China trade deal?
All the experts, and maybe Alan could go into it a little bit more than I can, but all the experts on TV said this is basically the same deal we had before. And it may open up U.S. markets to, dairy markets to Canada, but that's about the only change. Mexico is now our #1 buyer of corn, and they were buying before this agreement, and Canada tends to ship a lot of commodities into the United States. So the trade imbalances will remain about the same as I see it, which really wouldn't change things that much. It's just psychologically, you have a deal, and that's helping the markets today. As far as U.S. and China is concerned, there were some reports out on Friday that USDA is saying our carryout in beans is 845 USDA. It could be 1.1 billion bushels before it's all said and done. Last year, China took 28 million tons of beans from the United States. This group estimated they'll take 1 from us this year. So, assuming normal South American weather in 2019, for the bean complex, the lack of a deal with China is very negative.
Alan, looking at the financial markets, Thursday the Fed released the second quarter GDP number, which was 4.2%. How does this affect Federal Reserve policy?
Well, not that much. It still appears that the Fed is on track to hike interest rates at their December 19th meeting by 25 basis points. It also still appears that the Fed will be raising rates next year. I'm thinking maybe only 2 more times, although the consensus view is for 3, possibly 4 more times. But even beyond, the Fed, I think, will be raising rates into 2020. So the trend is for higher rates from the Fed, and I think that the duration of rate increases will be a bit longer than most analysts are currently calling for.
So if we go into 2019 and into 2020, where do you think these rates could level off?
Well, if there's 2 more rate increases in 2019 and a couple more later, maybe somewhere around 3%, 3.25%. We'll have to see what it looks like when we get there. I think it's more important to look at the length of time that rates are likely to increase and what the economy looks like down the road in 2020 as far as predicting any type of stock index outlooks.
So even 3.5% interest rate, still historically low.
It is absolutely very low, and in fact in the 80s we had a Fed funds rate averaging around 8%. We still had bull markets then. So I believe we are not even close to an interest rate that will tip over this bull market in the indices.
Alan, can you comment on yesterday's U.S.-Canada trade agreement and how it might affect interest rate futures markets?
Well, clearly, it indicates, suggests a stronger North American economy. That is, of course, bearish for the interest rate futures markets. They're lower today, as a better economy means higher interest rates and lower futures. So this is another negative for the bond market, and I would expect lower prices to continue. So I would continue to sell rallies in the interest rate futures markets, especially at the long end, the 30-year bonds.
And what does this agreement do for the stock indexes? I see we opened up strong this morning.
Right. Well, stock index futures, I believe, would have continued to advance without an agreement. But the fact that we do have the trade agreement announced yesterday, late yesterday, suggests that there is just a better economy coming for not just the U.S., but also for Canada and in general North America. So this, I believe, it has given an additional boost to stock index futures, which will continue all of this year.
Thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.